Imagine a world where the creation of money is intricately linked to a mysterious, predetermined code, having its rewards at every calculated interval. This intriguing mechanism is known as Bitcoin halving. With each halving event, the rewards for mining Bitcoin are slashed in half, inevitably affecting its scarcity and potentially its price. But how exactly do these halving events impact Bitcoin's long-term price trajectory? Today, we delve into the intricate dance between supply, demand, and investor psychology to explore this fascinating question. To understand the impact of Bitcoin halving, let's first clarify what it entails. Bitcoin operates on a decentralized network where miners, individuals who use computational power to secure the network and validate transactions, are rewarded with new Bitcoins. Approximately every 4 years, or every 210,000 blocks, this reward is cut in half. This process is built into Bitcoin's code by its pseudonymous creator, Satoshi Nakamoto, as a means to control inflation and mimic the scarcity of precious resources, like gold. Historically, halving events have been significant in shaping Bitcoin's market dynamics. The first such event occurred in November 2012, when the reward dropped from 50 to 25 Bitcoins per block. This reduction in new supply played a pivotal role in stimulating a price surge from around $12 to over $1,100 within a year, illustrating how decreased supply, paired with existing demand, can drive prices upward. Fast forward to July 2016, the second halving event created a similar spectacle. The reward was further reduced to 5 Bitcoins per block, and as history would have it, another major price rally followed. By December 2017, Bitcoin reached an all-time high of nearly $20,000, largely driven by heightened media attention, speculative investment, and the increasing realization of Bitcoin's potential as an asset. Yet it is not just scarcity that influences Bitcoin's price after a halving. As the reward decreases, mining operations face increased pressure due to reduced profitability, forcing some smaller players out of the market. This consolidation can strengthen the network by concentrating mining power into more efficient, robust operations, but it also highlights the ever-important balance between security costs and Bitcoin's value proposition as a decentralized currency. The psychological aspect of Bitcoin halving also cannot be underestimated. These events are anticipated well in advance, creating a narrative of scarcity that can lead to speculative behavior. Investors often expect price increases post-halving, fueling demand ahead of the actual event. This anticipation can lead to price volatility as markets react not just to the halving itself, but to the myriad of investor expectations surrounding the event. Now, let us consider the broader implications for Bitcoin's long-term price trajectory. As halving events continue, the reward for miners approaches zero. This limited supply of Bitcoin pushes it further along its deflationary path, making it increasingly scarce. In economic terms, when a commodity is widely sought after as Bitcoin becomes more scarce, its value tends to increase, assuming demand remains constant or grows. However, Bitcoin's long-term price trajectory is not solely dependent on halving-induced scarcity. The evolution of regulatory frameworks, technological advancements, environmental considerations concerning energy consumption, and the adoption of Bitcoin by institutional investors all play pivotal roles. These factors, combined with the inevitability of future halving events, shape not only Bitcoin's price but its standing as a legitimate asset class. Interestingly, Bitcoin halving fosters a unique market cycle characterized by accumulation, price surge, correction, and stabilization. Post-halving, reduced supply often precipitates a bull market. But as speculative excesses reach their peak, corrections follow, leading to a more stable price level, albeit at a higher average than before the halving. Cyclical nature underscores halving's profound impact on Bitcoin's long-term price trajectory. As we reflect on Bitcoin's journey, it becomes evident that halving events are more than mere technical adjustments. They are central to Bitcoin's narrative, sculpting its economic model and influencing market sentiment. By controlling supply increments, halving events foster an ecosystem where Bitcoin's scarcity is celebrated, its resilience tested, and its value proposition as a decentralized asset reinforced. In conclusion, Bitcoin halving events are a critical component in understanding its long-term price trajectory. While the immediate effects are often dramatic, their legacy lies in steadily reinforcing Bitcoin's scarcity amidst a growing interest in its broader potential. As more investors and institutions recognize Bitcoin's value, its price trajectory will continue to evolve, guided by the unrelenting march of these halving milestones. Thus, in the ever-compelling world of Bitcoin, it is clear that halving events are not just technical occurrences, but pivotal moments that shape its future.